Okay. Alma Limited is a Zambian medium-sized manufacturing firm listed on the Securities Exchange. It is considering an expansion of its production capacity and wants to assess the cost of financing from various sources. Below is an extract from the balance sheet. Ordinary shares, 15 Ngwe, par value 2,000. Okay, so these ordinary shares were sold at 15 Ngwe, and this company made 2,000 kwacha. 12% loan notes, 1,500. This is debt. 8% preference shares, 1 kwacha, par value 500. Okay, these preference shares were sold at 1 kwacha each, and they made 500,000. Additional information: the company's equity beta is 1.2. Government bonds in Zambia yield 6%, used as the risk-free rate. The market risk premium is 7%. The company loan notes are trading at 106 kwacha per 100 kwacha nominal, and the before tax cost of debt is 10%. The preference shares trade at 92 Ngwe per share. The current market price of the ordinary share is 1 kwacha 25 Ngwe. The corporate tax is 30%. Calculate the market value of each component of the company's capital structure. Okay, so market value of ordinary equity, market value of preference shares, market value of debt. So when we talk about market values, this is the value according to the stock market. Okay, these are the current values. Book values are the historical values. Okay, the ones in the balance sheet, they're more historical. Market values are more current. So colleagues, do we remember the formula I taught you last time? Let's start with market value for ordinary equity. It's the market value. Do we remember the formula? Remember, these are the last hours. Okay, so you would want to remember this formula. Okay, this full question is 25 marks, and you do not want to give up the 25 marks. Yes, Mr. Yes, Mr. Trywell, what's the formula for the market value of equity? Let's see who's in the class. Yes. Okay. Yes, Mr. Trywell. Madam Kalinda. Because this formula won't be given to you. Okay. Madam Precious. Oh no. Okay, colleagues, remember this formula from today until you graduate. Okay, until you graduate, you can forget this formula. For the market value of equity, it's the ordinary share capital divided by, let's put it like this. It's the number of shares times the market price. Okay, number of shares times the market price. Now we don't have the number of shares, so the way we get the number of shares is the ordinary share capital divided by the par value. Okay, just remember this: number of shares and the market price. So we have to get the number of ordinary shares this company has. So the number of ordinary shares is the ordinary share capital, or SC, ordinary share capital, divided by the par value, PV. Alright, so the ordinary share capital 2 million kwacha. Par value 15 ngwe, so you put 0.5 kwacha. Okay, divide this by 100. Convert ngwe to kwacha, divide by 100. Okay, so 0.5 divided by 2 million. Ordinary share capital over par value. And 0.5 divided by 2 million. Colleagues,
4 million.
4 million, yes. So our 4 million shares. So we're going to multiply 4 million by this market price 1.25 here. Okay, so 4 million times 1.25,
5 million.
Any questions?
So that's the market value.
Yes, the market value of equity.
Of equity.
Yes. Any questions? We go to the market value of debt. VD. So notice the formula is going to be the same for all these forms of capital, okay? So market value of debt is the number of loan notes times the market price. Number of loan notes times market price. So colleagues, how do we find the number of loan notes? Okay, the way you get the number of loan notes, it's just the value of the loans, 1.5 million, divided by the par value. Okay, this is the par value of the loans, 100 kwacha. Okay, this is how much is paid to you when the loan matures. Okay, so you're going to say 1.5 million divided by 100, you get 15,000 loan notes. Okay, so the market price of the loan notes 106 kwacha. So you say 15,000 times 106 kwacha. Are we getting this value 1.5? 1,590,000. I was calculating fast when doing this, so So I want to make sure so that should this question come, for those who like memorizing answers, you shouldn't put 1,590,000. Okay, let's make sure these values are accurate. I was calculating fast yesterday. So is 50,000 times 106 1,590,000?
It's correct.
Any questions? Market value of preference shares. Okay, number of preference shares times the current price. How do we get the number of preference shares? It's the preference share capital divided by the par value. Okay, so 500,000, which was the preference share capital, divided by 1 quad, which is the par value of the preference shares, you get 500,000 preference shares. Okay, so the market value of the preference shares, 500,000 times 92 ngwe, you get what do you get? You get 460,000. This is the market value of preference shares. Are we okay with this, colleagues? Are there any questions? Have we jotted down this formulae? Okay. Yes, colleagues.
Yes, sir.
Mm.
Yes, you should share the document as well, sir. You go through it.
I should share there.
There's some documents.
Oh, I've sent it in the group.
Oh, you have sent it?
Yes, yesterday.
Yeah. Okay.
Colleagues, all these documents I sent, I thought you'd by morning today so you never went through them in the morning. Eesh. Okay. Yeah, they're in the group. It's written as question 1, past paper question 1 Wacc. Okay. So everything we'll look at today, the notes are in the group. Okay. So we've got the market values of equity, preference shares, and debt. Are there any questions? And have we remembered the formula? It's just the number of whatever this form, if it's shares or debt, number of whatever, times the market price. Then to get the number, it's just that balance on the amount on the balance sheet divided by the par value. Madam Kalinda, are we okay with that? Madam Precious, are we okay with that? Mr. Medad, are you okay with that? Madam Lindiwe, Mr. Chanda, Mr. James, Mr. Triwell, I don't need to ask. Are we okay with that, colleagues? Okay. Based on the results above, calculate the proportion or the weight of each component of capital in the firm's capital structure, expressed as a percentage of total capital using market values. So here, colleagues, we are determining the weightage of each form of capital. Remember, capital structure just tells you how much equity financing, how much debt financing. So this is what we do. We'll just add up these market values. Okay, you say market value of debt 1,590,000 plus market value of preference shares 460,000 plus 5 million. Okay, so that we get the total capital. Okay, 5 million plus 460,000 plus 1,590,000, you get the total amount of capital. Then each of these, you say 5 million divided by this 7,050,000, that's the weight of equity, which is 0.7092 or 70.92%. Okay, this company is using 70.92% of equity financing. Preference shares 460,000 divided by 7,050,000, 0.0652, which is 6.52% preference share financing. Debt 1,590,000 divided by 7,050,000, 0.225 or 22.5% debt financing. These, all of these, when you add them up, they should add to 100. So I got 99.9 when I added them up. So maybe one, you can round it off. Okay. Yes. Any questions? That is the weightage of each form of capital. So this question is breaking down like the steps of solving questions on WACC, weighted average cost of capital, because these are the steps you do first. You get the market values first. It's advisable to get the weightages next, because once you get the weightages here, by the time you reach the formula, it's just a matter of substitution. Okay, so are there any questions before we move further? Okay. Did I finish the whole question down? And I think the next part of the question was to calculate the cost of capital for each, then to get the weighted average cost of capital. Right? Yes. So let me just open up the original document so I see if I missed out any other information. Yes. So the next part is calculate the cost of each component over capital. So we're going to start with the equity. You look at the information. Since they've mentioned equity beta here, okay, we know that we use the capital asset pricing model. Okay, not the dividend valuation growth model. We use the capital asset pricing model. Colleagues, what does the capital asset pricing model tell us? Because you might find a question on theory. Okay, we're also going to do a bit of theory, because it's not just calculations tomorrow. Yes? Yes, Madam Kalinda.
Is it the one where you do R is equals to 3 formula?
Yes, is that one. The risk-free rate plus equity beta. But now, what is that telling us? Madam, you were there in that class that day. Anybody? What does the capital asset pricing model tell us? It tells us the more return you want, the more risk you have to incur. Okay? Remember the formula? Madam, you have remembered after I've said now. That's unfair, colleagues. That's unfair. Okay. Oh, I closed the page. Let me open it again. Yes. So it's the more risk, the more return. Don't I close the paper by mistake? Here it is. Okay, so here's the CAPM formula. So this is the formula here. Let me underline it. The risk-free rate plus equity beta multiplied by the market risk premium, which is the return on the market minus the risk-free rate. Okay, this market risk premium is when you subtract return on the market minus the risk-free rate. Colleagues, what is that market risk premium telling us in simple words? I believe all of us are directors of finance. Maybe it can be in the household, maybe it can be in the church. Okay. What is this telling us, this market risk premium here? It's the extra return that you get when you invest in risky investments. Okay? Because according to the stock market. Okay, these risk-free investments will give you low returns. Investments that have got risk are going to give you higher returns. So someone who invests where there's a higher risk should get more than someone who invests in a risk-free investment. Are we okay with that, colleagues? This market risk premium is just the extra return for choosing a riskier investment, in simple words. Okay. So, risk-free rate 6%, equity beta 1.2, market risk premium 7%. Okay, so you're going to say 1.2 times 7, that's 8.4%. Plus 6%, you get 14.4%. Any questions? Any questions, queries? Madam Kalinda, any questions? Madam Precious? Who else is here? Mr. Chanda, any questions?
Sir, is there a way of calculating those market values using a table? Where you just key?
No.
Okay.
Mr. James, any question? Madam Lindiwe? Mr. Medad? Madam Nonde? Madam Precious? Madam Ruth? Madam Sarah, we are looking at the question for work. Not worry, it's a recording. Okay, so you won't be left behind. Alright, so we now get to calculate the cost of preference shares. Okay, it's the dividend for each preference share divided by the market price. Okay, how do you get the dividend for a preference share? 8%. This is the dividend rate here, and this is the interest rate. Okay, if you're wondering what are these percentages, this is the interest rate, this is the dividend rate. So you're getting 8% of 1 kwacha. Okay, so if you bought a preference share for 1 kwacha, you'll be getting 8% of 1 kwacha, that's 8 ngwe. Okay, so if you just bought one preference share, you're getting 8 ngwe per year. Colleagues, what can you do with an 8 ngwe for the whole year? What can be done? What sensible thing can be done with an 8 ngwe? So the market price, 92 ngwe. 0.08 divided by 0.92, 0.08, 8.7%. That's the cost of preference shares. Any questions? Wonderful. Okay, the cost of debt, they've given us the before tax cost of debt, so want the after tax cost of debt. So it's just the before tax cost of debt. In the question they told us what was the before tax cost of debt. 10%. Tax is 30%. So you're going to say 10% minus this 30%, you convert it to a decimal 0.3. So 10% times open brackets 1 minus 0.3, that is 0.7. 10% times 0.7, 7%. Any questions? Okay, so we get to tabulate the weighted average cost of capital. This is just the overall cost of financing from the business's perspective. From the investor's perspective, that's the minimum required rate of return. Okay. So this cost of preference shares here, this is the minimum required return that will make a preference shareholder happy. Okay, that cost of debt, the minimum required return that will make that debt holder happy. The cost of equity, the minimum required return that will make that ordinary shareholder happy. So when you combine it as WACC, it's the overall minimum required return for the investor. Then to the business, the overall cost of financing. So remember, the formula for WACC is just the cost times the weightage. Cost of equity multiplied by the weightage of equity. Cost of debt multiplied by the weightage of debt. Cost of preference shares multiplied by the weightage of preference shares. Okay, so you're just multiplying the cost by its weightage so that you get the overall cost. Okay. So since equity financing has the highest weightage, it's going to have more influence on this cost than these others because its weightage is high. Cost of preference shares, weightage of preference shares. Yes, so that's what we'll do. As you can see here, weightage of equity multiplied by its cost. Weightage of this one shows 8.7%. It was which one? Weightage of preference shares multiplied by the cost of preference shares. Weightage of debt multiplied by the cost of debt. When you do your multiplications, you add all of these, you get 0.1236, which is 12.36%. So any project you invest in, because this WACC is used as the discount rate in your investment appraisal or capital budgeting. So any project that you invest in, the return should be greater than 12.36%. If the return of that project is less than 12.36%, do not get it, because you're saying the cost is outweighing the return. You want the return always to outweigh the cost. Any questions?